Good day all. I am Dr.T.Arunmozhi, Assistant Professor and Head, Department of Commerce, KCS Kasinadar College of Arts and Science. I welcome you all for the presentation on Absorption Costing Part 2. It is based on the curriculum of all universities on this subject. The contents are Absorption Costing, Marginal Costing versus Absorption Costing, Concept of Contribution, Marginal Cost Income Statement, Profit Volume Ratio, Breakeven Analysis, application of it, assumptions of break-even point. Now here we have the differences between absorption costing and marginal costing. This picture depicts the differences here. Cost can be in absorption costing. Cost can be differentiated between manufacturing cost and non-manufacturing costs. Manufacturing cost, it is again classified into direct material, direct labor and overheads. This is the basic difference between absorption costing and marginal costing. Whereas in absorption costing, we call as only one term as overheads, but in marginal costing, we see the two terms as variable overheads and fixed overheads. Next, again, overheads can be as finished costs, which leads to cost of goods sold and profit and loss account. In non-manufacturing costing, it is called as period costs, again to profit and loss account. Now we pass on to marginal costing. Again, it is classified into two, manufacturing cost and non-manufacturing costs. Manufacturing cost has direct materials, direct labor. As I have told you earlier, it is classified as variable overheads and fixed overheads. Again, these overheads turn to finished goods, cost of goods sold and profit and loss account. Non-manufacturing cost is only with the period cost. Now the differences between marginal costing and absorption costing. Here cost is split based on function, that is a production or non-production. In marginal costing, it is based on behavior, either it is variable or fixed. In absorption costing, the inventory is valued at the full production cost, but in marginal costing, it is valued at the variable production cost only. Next, sales minus cost of sales is equal to gross profit in absorption costing. In marginal costing, it is sales minus variable cost is equal to contribution. Here, in absorption costing, non-production overheads are deducted after gross profit, whereas in marginal costing, non-production overheads are deducted from contribution. Now we pass on to the term contribution. It is the profit before adjusting the fixed cost. It is an assumption that excess of sales over variable cost contributes to a fund, not only which covers fixed costs but also provides some profit. If contribution is equal to fixed cost, company achieves break-even. This concept helps in taking decisions like whether to produce or discontinue, or fixing up selling price or bulk orders. The marginal costing, there is an income statement showing sales minus your variable costs. For example, the amount column and the cost per unit column is given. Sales minus your variable cost is equal to contribution. Contribution minus fixed cost is equal to profit. Here with the figures it is depicted. As an example, contribution is a profit before recovery of the fixed costs. The formula for it is, it can be attained according to the sums, the particulars given. Contribution is equal to sales minus variable costs. Contribution is equal to fixed cost plus profit, or contribution is equal to fixed cost minus loss. We have the PV ratio, profit volume ratio. It expresses relationship between contribution and sales. PV ratio is equal to contribution divided by sales into 100. Contribution or sales ratio or profit volume ratio can be depicted in percentage, and in amount also it is given. PV ratio is in percentage, it is contribution by sales into 100, as we have seen. Here, change in contribution divided by change in sales. Suppose 2 years sales will be given and 2 years profit will be given. It changes accordingly. Again, change in profit divided by change in sales. Next concept which we pass on to is break-even analysis. It is also called as cost volume profit analysis. This break-even analysis is a study of relationship between selling prices, sales volumes, fixed costs, variable costs, and profits at various levels of activity. The application to it is, it can be used to determine a company's break-even point. It's a level of activity at which the total revenue is equal to the total cost. That is, no profit, no loss. At this level, the company makes no profit. Assumptions of break-even point. The relevant range. The relevant range is a range of an activity over which the fixed cost will remain fixed in total and the variable cost per unit will remain constant. Fixed costs are assumed to be constant in total. Variable costs will increase with increasing in number of units produced. The sales revenue. The total revenue will increase with the increasing number of units produced. Break-even point. The formula. In units and in rupees it is given. Total fixed cost divided by contribution per unit. Suppose break-even point in rupees is given. It is total fixed cost divided by PV ratio into 100. As I have told you, it is a stage where firm is making no profit, no loss, or total sales revenue is equal to total cost incurred. Calculation of sales to break even or earn a given profit. This formula applies. Last, we pass on to break-even analysis chart. The relationship between costs, sales, and profits can be shown in the form of a chart. Such a chart not only depicts the level of activity where there will be neither loss nor profit, but also shows the profit or loss at various levels of activity. According to the Indian Institute of Cost and Management Accountants, London, the break-even chart means a chart which shows profit and loss at various levels of activity. The level at which the neither profit nor loss is shown being termed the break-even point. This may also take the form of a chart on which is plotted the relationship either of total cost of sales to sales or of fixed cost to contribution. Thus, it is a graphical representation of cost and revenue data so as to show their interrelationship at different levels of activity. Now, the method to follow is, on the x-axis of the graph is plotted the volume of production or the quantities of sales, and on the y-axis, that is a vertical line, cost and sales revenue is represented. The fixed cost line is drawn parallel to the x-axis because with any volume of production, the fixed cost shall remain the same. The variable cost line is depicted above the fixed cost line, which shows that the cost is increasing with the increase in volume of output. This line also can be regarded as a total cost line because it starts from the point where variable cost is 0, a certain fixed cost has been incurred. Thereafter, figures of sales are plotted from the origin and a line is drawn up which goes in the upward direction with the increase of production or sales. The two lines, total cost line and the sales line, shall intersect each other at one point, and a perpendicular can be drawn from this point to find out level of output where the business shall be at no profit, no loss position. Since the total costs are equal to the total sales revenue here, if the business produces less than this level of output, it shall be running at a loss. The portion of loss is shown by the lower sales line and upper total cost line. If the business produces more units than the break-even level, profit shall result and it shall be higher and higher as the production or sales increases. This is indicated by upper sales line and the lower total cost line. Hope you would have understood the concepts. In the next video we would meet. Thank you.